Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss when renting makes sense. Inflation ticks up in January, beneficial ownership reporting requirements, and a look at the Plan Solutions Incorporated Office Bulletin Board. Mr. Armour, how are we, good sir?
Hanging in there. Middle of tax season, and I can't seem to kick this cough that I've had for a couple of weeks. But, you know, the time changes this weekend. Spring's almost here, so, you know, it's only got to look up from here, right?
Yes, sir. Well, I wonder, everything's kind of blooming, and it's weird. Been a weird year already. All right. Well, let's jump into when renting makes sense. There is a general overview that renting a home is just throwing away money. We've talked about this before, building equity and such. But there are situations in which maybe it doesn't make sense to own and it's more beneficial to rent. So let's dive into some of those.
Yeah. I think, there's this view that, renting versus owning and accumulating equity, right, just doesn't make sense. And, I think that's not necessarily the right way to look at it. When you look at something that has high transaction costs, high cost of ownership, potentially loses a large amount of its value after purchase, right? That's when, you probably want to really think about it and weigh the pros and cons of renting versus ownership. And see which is the right fit for an individual situation, right? Housing is a great example. Obviously, has high transaction costs to get in and get out, and potentially high cost of ownership with home maintenance and everything that goes along with it. So in some cases, renting, it's a way to gain access to shelter without having to have the down payment, without paying the high transaction costs and buying and selling, and without having the cost of repairs and maintenance, right? And so that may work for someone. On the other hand, you can make a case that there are situations where buying is better, not necessarily because you're building that equity and things. The way I like to look at buying a home is that it's a way of prepaying the rental expenses later in life. What I mean by that is, if you buy a home, you pay off a 30-year mortgage over the next 30 years. And when you go into retirement, or maybe at some point in retirement, that home is paid off, then, you no longer have those costs of shelter that you otherwise would be paying in, let's say, rent in retirement. And that can be attractive and make a retirement plan work out much better. Of course, not everyone does that, right? You see a lot of cases where people buy a home on a 30-year mortgage, 10 years in, refinance back to another 30-year mortgage, 15 years later, do a cash out refinance to a 30-year mortgage. In essence, they've kind of just rented that home for that entire time period, right? They never got that benefit of prepaid rent, and they didn't really build the equity. And, you have to look at it and say, from a financial standpoint, was that really better than renting, especially if, they had the high maintenance and repair costs along the way?
Yeah, well, and we've talked about that in some other past episodes too, where oftentimes with that constant, well, not constant, but refinancing every 10 to 15 years, and people doing it to pay off credit cards and such, and it's just not necessarily always the most advantageous strategy, but there are good reasons to do it. We do. Some people, I've been there, I've had to rent, up until maybe 10 years ago, because the cash flow wasn't there. I didn't have good cash flow, and all of those things that you pointed out, maintenance costs were going to be hard for me, a down payment, etc. So, it was a situation where I had to look at what was the most advantageous approach to having shelter.
Yeah. You have to look at your situation. And in other cases, you may not plan on being at a location for a very long time period, or It may be uncertain. I mean, one of the things that I think often makes sense is when someone moves to a new city or state, right? Maybe that's because they're retiring. Maybe that's because their job has been moved. Because real estate comes with high transaction costs, it can be costly to switch from one home to another, even within a given location. So when moving, it can make sense to rent for a year and get the lay of the land, determine what neighborhoods and the associated amenities and things, best fit the desired lifestyle. And it can take some time living in that new location to find where that right fit is. Too often you see people sell in, their previous home, buy in the new location, then they're there for a short time period and say, oh, well, actually, we want to be over here. Well, if you're paying a 7% transaction cost on a very high value purchase like a home, that's a significant amount of money. Chances are you didn't build that much in equity over that time period, that short time period you were in that new home. And after transaction costs, you actually come out worse off versus if you had been renting and maybe, continuing to save and accumulate a larger down payment and then be able to find, okay, what is that long-term home? In the right location, the right amenities, the right everything that you're looking for.
What about situations now? We have talked about some of the changes in laws. If an individual or a couple sells a home, as far as gains and the tax ramifications.
Yeah, I think part of the buy versus rent equation is I still run into this misconception about selling your personal residence. Many, many years ago, I mean, we're talking 20, almost 30 years ago, the rule was if you sold your personal residence, as long as you bought a home of equal or greater value, you avoided paying any taxes on the gain on the sale. It basically rolled over into the new property. But that was replaced with the personal residence exemption. So under current law, taxpayers have a $250,000 exemption. That's 500,000 for a married couple, so 250,000 times two, where they can just avoid paying taxes on the sale of their primary residence, right? They don't pay taxes on that amount of net gain. And it does not require that the money be reinvested in a new home under any time period. So it creates a situation where you can sell, you can get the tax benefits of selling the primary residence, and then you have the flexibility to go rent for a while and then maybe decide on that next purchase or maybe determine that just renting is the right fit depending on the situation.
Yeah, and you do point out there, or I want to point out what you were using wording wise, primary residence, not this isn't a vacation home or a rental property. This is your primary residence.
Correct. Yeah, it has to meet those requirements under the law to qualify for the personal residence exemption.
Now let's talk about with that tax laws around. Maybe you are a landlord as opposed to the homeowner or renter. What are some of the advantages there?
That's right. That's another weird thing in the tax law. Currently, you actually get more preferential tax treatment being a landlord than you
Huh.
do as a homeowner. And it may sound crazy, but people that want to build wealth through real estate and get the most tax efficient opportunities may find it's actually better to buy a home and rent it out as an investment property and then rent for their primary residence,
Mhm.
right? That they still own a home, they're still building equity through real estate, but they're getting better tax treatment over time than they may in their personal residence. Again, this depends on everyone's situation. I understand there is some psychological benefit to owning your own home, and that's important to some people, and that's fine. But understanding those trade-offs, I think, can be valuable when determining what's the best decision. A lot of times, what we see is people in really high cost of living areas where it would be very difficult to buy or maybe because cash flow would be so tight they'd have to sacrifice longer term goals like retirement funding and other things that also are tax advantaged. May find that it's actually more financially advantageous to rent in that high cost of living area and then buy rentals in lower cost of living area where it's just more affordable and they get the benefit of the favorable tax treatment.
Yeah. Well, what about a situation? I do believe we did talk about this, but it's been quite a while because I had inquired with you about, recreational vehicles and such. I had an individual that I knew bought a very, very upscale boat, and I was questioning how they afforded it. Well, they were paying a very long-term loan on it, which I was unaware that was even possible. But what about things like recreational vehicles and such?
Yeah, I think those can also, it can be a great option to rent at least initially,
Mm.
right? And make sure that it's the right fit. I see that a lot with things like RVs, right, or motorhomes. I mean, the bells and whistles on these things are pretty impressive now, and of course that comes with a pretty hefty price tag. I think a lot of people see that and think, oh yeah, that lifestyle is appealing to me. I want to go do that, spend time on the road, go, see the country. But I think you could definitely make a case for maybe renting one for the first couple of trips and make sure that it's the right fit. I've seen too many situations where people have made very large financial commitments into these vehicles, and then within a short time period decided it just wasn't for them, right? Either they didn't like driving it, they didn't like the setup and tear down every time they stopped. Maybe just circumstances changed, right? And then they're turning around and they're selling it and they're taking a big loss because selling it used, they're just not getting the value out of it. And then you could even argue that with some just really expensive vehicles, right? I mean, with what things cost now. Obviously, you can go to a dealership and take a test drive and say, yeah, this looks good, but it's a pretty short time period to be able to gauge that. Whereas in many cases, you could go and you could rent it for a few days or a week, see how it fits in your garage, see how you like it, after just that initial impression wears off, which is really not that expensive compared to the overall cost of the purchase. And so then when you do decide on the right vehicle, you're more confident this is something you want to hold on to. Because one of the big risks with buying a vehicle, especially if it's new, is that it loses so much of its value the minute you drive it off the car lot.
Absolutely. Well, I did bring up earlier vacation homes or potentially that second home. What about situations when it comes to vacation property?
Yeah, that's another area where I think people should really weigh the large financial commitment of owning versus renting, right? How much value are you really going to get out of personal use versus renting a vacation home? It can be far less costly after all the financial factors are included, right? I mean, you're paying the mortgage, you're paying taxes, you're paying insurance, utilities, everything, whether you're using it or not. It's in a fixed location. Maybe that doesn't end up being the place that you want to go for all of your vacations, especially if your vacation's limited, based on work obligations and amount of time off and things like that. Whereas, renting, yeah, it can be costly, for that given transaction, but compared to the big picture, it may be, it may be more financially prudent.
Absolutely. Anything else you want to add before we jump to inflation ticks up in January?
Just that I think all of these things are conversations that people should really dig into before making those big financial decisions, and maybe find someone to bounce the pros and cons off. So at least they're making an informed decision. Maybe they'll still follow through and do what they initially wanted to do, but they'll understand all of the pros and cons.
All right. Inflation ticks up in January. U.S. consumer prices increased 0.5% in January. The market responded to that. What do we want people to understand about this? What's the Federal Reserve doing in response? And is there any projections that we can kind of, look at based on histrionics?
Yeah, I think there's kind of the short term picture and the longer term picture here, right? So yeah, inflation up 0.5% in January. That's a pretty big move for 1 month, right? If that continued every month, that would be a 6% inflation rate, which would be kind of in between where we are now and where we were at the height of this inflationary period. But the bigger picture is that the annualized inflation rate went from 2.9% in December to 3% in January. So tiny little increase, not an overall big impact. And so I think we need to keep that in mind. I also think digging into the data, there's a few key takeaways. So one of them, as we've talked about, is that services prices have continued to be very sticky. And what we mean by that is they're just not changing very quickly, but they have been trending downward for quite a long time, just very, very slowly. And that's been the primary source of inflation that we've seen. But in January, we did see services prices tick down slightly. It went from a 4.4% annualized rate to 4.3%. So, we would look at that as a big positive that that trend, continues. We continue to see services prices moderate and kind of revert to the mean. And given that services represent over 60% of consumer spending, that's the bigger broad category.
Yeah.
So of course, looking at that, then it's like, well, okay, well, if that came down a bit, then why did the overall inflation rate go up? Obviously, it'd be from the other category, which is goods.
Hmm.
And goods prices have been very volatile. They were very high during the peak of inflation and have come down a lot. In fact, previously, the goods inflation rate was basically zero, right? So you had services at the 4+% range. You had goods at zero, and it was averaging out to kind of the high 2% range. But what we saw in January is that the goods prices increased 2%. And that was with food prices going up 2.5%. That was with energy going up 1%.
Mm.
Obviously, if those numbers stayed there, that's totally manageable based on historical norms, right? Both below 3% or averaging out to that 2% range that's the Federal Reserve target. So it's not necessarily a bad thing that we saw a tick up in goods inflation because it's still in check, and we're seeing services still continue to slowly come down. So even though the January headline of inflation ticking up got people's attention and was viewed as a negative, the truth is we can still see a path of inflation continuing to moderate to between that 0 to 2% range that we'd like to see.
So there's a lot of positive signs, and as you said, services. It's interesting to take a look at what falls under the services category. Shelter and some other areas and aspects. So yeah, it's interesting how the balance is coming about to see where we go. Any response from the feds? What are they looking at as far as interest rates? Any predictions there?
Yeah, well, after lowering their target interest rate in their last three meetings, right, in 2024, the Fed paused during their first meeting here in 2025. So, obviously they would like to see inflation improve a bit. I think they felt like they'd already lowered interest rates by a full 1% in 2024, so it was worth just waiting and getting some additional data. But again, digging into the report, seeing that the longer term trend of inflation slowly coming down, arguably is still intact. I don't think this changes the Fed's long-term trajectory. Maybe it changes the timing a little bit.
Okay, thank you. All right, well, let's jump over to beneficial ownership reporting requirements. There is a new law that requires taxpayers to report their beneficial ownership. What are some of the entities that they would be a beneficial owner?
Yeah, so this is an interesting one. Between the time of this newsletter coming out and here us recording the podcast, things have changed yet again. There's been a lot of change here, but basically there was a law that said anyone who's an owner of an entity, whether it's a partnership, LLC, subchapter S corporation, that they were required to report the information of all of the owners of that entity, right? The purported goal is to be able to avoid or fight fraud, money laundering, things like that. People trying to hide assets and series of these different entities to make it hard to track, and that the federal government, the Financial Crimes Enforcement Network, would have a database where they would be able to track each of these entities and who were the owners, right? And so the requirement was giving some information, social security, date of birth, and upload a copy of an ID like a passport or a driver's license or something like that. So originally this law was supposed to take effect in 2024. And a federal judge had delayed it on constitutional grounds, right? The question is this constitutional? That law is still, or that lawsuit is still moving forward, but in the meantime, the federal judge had delayed it. But then on February 19th, a higher court ruled that the law can be implemented while the lawsuit moves forward. And so they set the new deadline at March 21st for people to file these beneficial ownership reports. So, of course, we started scrambling. We partly, the reason we put this in the newsletters, we want to make people aware of it if they have entities that we're not aware of, to make sure they go through this process. Well, very recently, the Department of the Treasury, which oversees the Financial Crimes Enforcement Network, basically came out and said they will not be enforcing this law. So they said you can do it if you want to, but you don't have to, and we're not going to enforce any of the penalties or any of the bad stuff that would happen to you if you didn't follow it. So it's technically still a law. It's not being enforced. It's just kind of in purgatory. And I guess we'll know one way or another as the lawsuit progresses whether this law will be constitutional and will be allowed to stand, or whether it will be considered unconstitutional and will just go away. And even then, if it is deemed to be constitutional and stays into effect, then the question will be, okay, at what point will the Treasury actually enforce it, if at all? So we're back into that waiting period. Obviously, it's something that we will continue to keep an eye on and try and keep people abreast of any changes that may occur. But yeah, it's been a bit of a roller coaster in terms of some of these new requirements.
As always, you and the team at Plan Solutions are on top of this, and we'll always keep you apprised as the best we can when we get updates here on the podcast, for sure. All right, well, let's jump over to the Plan Solutions Incorporated office bulletin board. We got one item pinned up there.
Yeah, so we've been talking to a lot of clients about the Social Security Fairness Act that passed, right? We discussed this where people that used to be subject to the government pension offset or the windfall elimination provision because they had years of work where they didn't pay into Social Security, their benefits may have been reduced or even eliminated, right? Where they just weren't eligible to draw. And especially during tax time, seeing people that have these government pensions and maybe a very small or no Social Security, right? That throws up a red flag for us. Okay, we need to have a conversation, make sure they're aware of what their options may be. And what I'm finding is even people that are aware of the Social Security Fairness Act may not be aware of all of the options. So, those that are already collecting a reduced amount of Social Security, they really don't need to do anything. The Social Security Administration says they will make the adjustments accordingly and make sure they're getting the full benefit that they should be. But those who are not collecting benefits, maybe because they never paid in enough to Social Security to be eligible, they may still be able to collect, not on their own record because they didn't pay in, but they may be eligible for spousal benefits on their spouse's record, widow or widower's benefits, even if their spouse has passed away, or even could potentially draw benefits on a divorced spouse's record if they were married long enough and meet the requirements. So in many cases, it's worth having a conversation with the Social Security Administration to see what options you may have and if there are benefits that you could draw.
Yeah, you also point out as well that if your benefits are increased or you received one of those lump sum payments that we discussed, how does that have a tax ramification?
Yeah, Social Security is taxable federally. It's not fully taxable, but for a lot of people, you see up to 85% of the amount received is counted as taxable income. So obviously, if people's income is going up, right, we want to account for that and make sure that we have proper tax withholding. And if they receive a lump sum, this law was retroactive back to January 1st, 2024. So, you could receive over a year's benefits in a lump sum. And we would want to look at the tax ramifications of that as well. So definitely something for people to keep an eye on. I also would say, I think the best way to deal with this is to either set up an appointment at the Social Security Administration at your local office or call the 1-800 number on the website If you're looking to draw on a deceased spouse, a current spouse, a divorced spouse, not only do you want to have your information, but you want to have their name, social security number, date of birth, and you may even need to show proof of marriage, such as the marriage certificate or something like that, to show that you have the ability to claim on their record, so that someone at the Social Security Administration can go through, do the analysis, and figure out what would be your best option. If you have the potential to draw on multiple records, you'd obviously want to have the information for each person's record, because the Social Security Administration will go through and figure out which one would result in the highest benefit.
Okay. Thank you for the information. Anything else you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Just want people to know we're a resource. I know some of this is kind of complicated, as we're seeing. There's a lot of rule changes, and it affects different people differently, right? Because it's all based on their circumstances. So we're here as a record. If people have questions and they want to talk through their options or what they should consider, by all means, give us a call.
Yes, sir. And we thank you all for listening to the podcast on either Apple Podcast or Spotify, where we ask you leave a rating and a review, or on YouTube. That's right. We have a YouTube channel where you can follow along to the personal financial review, the written content that we discuss. It's youtube.com/@plansolutions, or you can just search Plan Solutions and you'll find our page there. And if you want to subscribe to the personal financial review, all the written content that's always discussed here on the podcast, please send Katie an email. It's katie@plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.